Okay, the big question out there, I hear lots of seniors asking is, I'm retired or I want to retire, should I get a home equity line of credit, or is there some other product out there that better fits seniors? So that's what we're gonna do right now. We're going to, if you read my chicken scratch, and I've got a lot of chicken scratch to write up on this board. The question is a HELOC, we're gonna compare a HELOC versus something called a HECM line of credit. And for those of you who have seen this channel, been with me for a while, the HECM stands for the reverse mortgage. So reverse mortgage line of credit versus HELOC, what makes more sense in what situation? Because even though I'm a reverse mortgage guy, there are times where a HELOC actually is smarter to do than a reverse mortgage line of credit, although there aren't that many of them. All right, so first of all, before we get into this, if you're investigating reverse mortgages and you want to kind of go down the rabbit hole and see what these are and how they can work for you, then go ahead and subscribe. You can also, you'll probably see my information flowing somewhere here. My name is Jason Eichmiller. I run this channel, Reverse Mortgage Reality. Been doing reverses since 2008. My phone number is 888-309-9705. And my email is at jason@keyhomelending.com, or you can go to reversequotes.com, see a bunch of testimonials, and put your information in on the right, and I'll get in touch with you, pick a time to chat. So enough about that. Let's talk about the HELOC versus the HECM line of credit. Now, both of these are lines of credit. What a line of credit is, for those of you who don't know, a line of credit is you set up something on the side. It's money that you can take later on if you need to, okay? That's a line of credit. They set aside, your house is worth $800,000. You get X amount of money on the side. If you need it, you can take it. If you don't take it, you're not charged any interest, okay? So those are the big basics. So let's get into the differences though. First thing is a HELOC. We'll go over some stuff with the HELOC. The HELOC can give you more money. So if you need a lot of money in a line of credit, HELOC might be the way to go, okay? A HELOC is good for temporary. So let's say you're looking to sell your house. You need to do, maybe your realtor told you you've got to revamp the kitchen, maybe do some work on the bathrooms, maybe put down hardwood floors instead of carpet, that sort of stuff. Then a HELOC makes a lot of sense as short-term money because most of the time HELOCs are cheaper. So say short-term, cheaper. That's about all I got for advantages of the HELOC. Now, let's talk about the reverse mortgage line of credit for a second. We'll compare and contrast a little bit more with it. When we compare the HELOC to the HECM, the reverse mortgage credit lasts forever. And this is a big one. That means if you get a reverse mortgage line of credit at 62, that line of credit is going to be there and it's going to be growing, not just till 72, not just till 82, not just till 92, but until you meet your maker, okay? With the HELOCs, normally HELOCs have a cash draw period of about 10 years. So short-term cash. And the next thing is what scares me about HELOCs for retirement. It's short-term draw. Normally you have about 10 years where you can take the draw. The other thing is that if the economy drops, if your credit drops, basically the lender, these HELOC companies, these banks, they leave themselves a bunch of outs to where they can actually, this is scary, they can take away your line of credit. So what we've seen now in the market, we see home values are up here, they're starting to drop a little bit. If you got a HELOC here and your home value drops, let's say your house is worth 800 and your home value drops to 600, there might be triggers in there that allow the lender to say, all right, forget that, we're not going to lend them any more money. So that's not a good thing. So lender can halt the, I don't know if you can read this or not, my handwriting is terrible, credit line. Now with the reverse mortgage line of credit, or the HECM, stand over here so you can see this once I write, with the HECM, doesn't matter what the economy does, it doesn't matter what your credit score does, it doesn't matter anything. Once it's set up, nobody can take it back as long as you live in your house. So credit line. Credit line can't be taken away. Now, why is this a huge deal for retirees? Like, let's say you got a line of credit, and let's say it's not for temporary. Let's say you want to unlock an extra bucket of money that you can take later on when you need it. Maybe it's home health care. Home health care is a big one, actually. Folks use the HECM line of credit to kind of create an extra bucket as their own kind of self-insurance long-term care plan, which is pretty cool. But let's say you get your line of credit and you don't need it right away, but you need it in 15 years. But the HELOC, whatever happened with the economy or maybe you're past your draw period, you can't take it anymore. The HECM, truly, this is a set it and forget it, except for one thing. So we'll go deeper into this. This is one of the neatest aspects of the reverse mortgage line of credit, which I don't think can be found anywhere else. With a reverse mortgage line of credit, the line of credit grows every single year, tax-free. It's crazy. So I'm gonna write this down for you, but I'll illustrate a point. Grows tax-free. That means if your line of credit starts off at, let's say, $300,000, the line of credit growth for the deals that I'm doing right now, this is early December 2022. So it could be, if you're watching this in 3 months, the line of credit rates might be completely different. And just reach out, ask me, hey, what is the line of credit growing at right now? And it's a super easy answer for you. Even if you want to comment below, I'd be glad to answer that. But right now, the line of credit is doubling about every 9-ish years, a little bit over 9 years. So if you start with a line of credit at 62 and it's 300,000, in 10 years, it's going to be around a little bit more than 600,000. In 20 years, so let's say you're 62, now you're 82. You start with 300, round numbers, right? But your line of credit could be $1.2 million. Now, what happens? So let's say you're 82, you didn't need the money, but now you need it because you have a health adventure, a health situation. You want to stay at home instead of going to the nursing home. Or maybe you want to help your grandkids, or maybe your kids have a business that you want to help out with, you want to fund. A whole bunch of reasons to take money through a reverse mortgage. Well, you know, retirement has its unique challenges. But let's say that you got this line of credit, it was $300,000 at age 62. Now you're 82 and it's let's just say it's $1 million because the market slows down a little bit. And I'll explain how that works in a second. But let's say it's $1 million. But let's say your house, 20 years from now, your house is only worth $700,000. So you got $1 million line of credit here. Your house is only $700,000. My question to you, how much can you take? Number one, can the reverse mortgage company pull the plug? Number two, if they can't pull the plug, can you take $700,000 or can you take $1 million? Or are you capped at something else? You know what? Comment below. Let me know what you think. Write your comment right below and, well, you'll know in a second. In fact, push pause on this video and write your comment below. All right, here's your answer now that we're back. Number one, the reverse mortgage company can never halt that line of credit, so you still have that $1 million. Number two, once the line of credit is set up, it goes independent of home value. So the home could drop to be $300,000. It could be $700,000. It could go up on the other hand. It could be $2.3 million. It doesn't matter. Once the line of credit's set up, it's growing at its growth, kind of its growth rate. That means that if your house is worth $700,000, back to the original example, and you have a line of credit for $1 million, and you want a check from the reverse mortgage company for $1 million, they have to give it to you. They have to give it to you. You can get $1 million even if your home is worth less. Pretty neat, right? This is why, see, this and the next reason, the next kind of aspect that I'll talk about, this is why seniors really gravitate to the reverse mortgage line of credit versus HELOCs once they understand how it works. So the next feature about the reverse mortgage line of credit, which you'll understand here, this is not rocket science, is when you get a reverse mortgage line of credit, once you take money out of it, you're not making monthly payments on it. Although you are paying your property taxes and homeowners insurance because you still own the house. That's my fine print. You get a reverse mortgage line of credit, you must pay your property taxes and homeowners insurance. Forever and ever, amen, because you're a homeowner and you're still on the deed. So, no monthly payments for this guy. And think about the logic behind that. I'll just say monthly payments for the HELOC. But think about why that's important. You're retiring. Hopefully now, or hopefully soon. There aren't that many people who say, I want to work till I'm dead, right? You work hard for your family, but then you would like to have a retirement. Now, when you're in retirement, you're on fixed income. So to take money out while you're on fixed income, oh, and by the way, you might have some investments in the bank, but generally, if it's qualified money, meaning that the tax bill cometh, doeth, once you taketh the moneyeth, Uncle Sam gets paid. When you have that qualified money, you want to be careful about taking it. In fact, a lot of financial advisors say, hey, once you're 70 and a half, just take your RMDs. Don't take anything else if you don't have to. So thus, if you can set up a vehicle like the reverse mortgage line of credit, where you don't get taxed on the money you take out and it grows, and you still don't get taxed on the growth. It's kind of a neat thing. So why would no monthly payments be important for when you do take out the money? Because if you do, let's say you're retired, you take out $200,000, say for home health care to help your kids or something, and then you've got to make monthly payments on it. Well, have you ever heard the saying, robbing Peter to pay Paul? I know it's an old one, it's played out, but it's so true. You're getting the money, but then you're having to pay it back. It doesn't make sense. It doesn't benefit you as much as getting the money and not having to make payments. That's pretty obvious, right? So anyway, the no monthly payments. Think about no monthly payments. Think about credit line growth. Think about credit line lasts forever. It's like the three-headed monster right there. No monthly payments. Credit line grows tax-free, and it never ends, so the lender can't call you and say, I don't like this economy right now. You can't take any more money out. But I was expecting it. Tough. Go get a reverse mortgage. Think about that. And I'll give you the last point. Last point about all this. We've been doing this for 12 minutes. That's enough. All right. With the HECM, when you set up a line of credit, you've got an option of doing a few different things. So if you just need a line of credit, you can just get the line of credit. But what if at the inception you need to take a little cash? Or what if you do, like what I do with a lot of my clients is we do a financial worksheet. So we look at your income, and we look at your expenses. So we got both of those. What if you are, let's say, $300 a month short on your income versus expenses? What you would do then is you would do a kind of a combination. So you would take $300 a month. You can set it up this way this is why I love the reverse. It's so flexible. You can set up monthly income. So every single month, I'd probably give yourself like $350 a month just to give a little bit of a buffer, and then set the rest up. So you're getting $350 a month, then use the rest of the money you can get with the reverse, set that up in the line of credit. So you're getting your monthly income, so that's kind of keeping you even, so you don't have to take out of your qualified money or drain your savings account. Then have the rest in the line of credit that's slowly, it's not really slowly growing anymore, it's growing like almost 8% a year now, but it's growing on the sidelines, tax-free, so when you need it, if you need extra money, big cash infusion, you just take it from the line of credit. Again, leave your investments alone. All right, final thing I want to talk about. So I guess that's the four-headed monster of the reverse mortgage line of credit. The flexibility, the fact that you get it, you don't have to make payments, so you're not robbing Peter to pay Paul. It's growing tax-free, which is huge, and again, nothing else compares to it. And the bank can never say, hey, sorry, can't take money anymore. I would be remiss if I didn't talk about the HELOC again, though, the positives. If you're looking for short-term money, the HELOC is great. Again, if you want to just fix up your house to sell it, then the HELOC is an excellent choice. What else? That's about it. It's cheap. It's a little bit cheaper than the HECM because the HECM is insured by the federal government, and the federal government's insurance allows it to be non-recourse. It allows you to have that line of credit that lasts forever and ever. Amen. So I would say if you look at it long-term, and the clients that I've helped and the financial advisors that I work with, the benefit that you get as you've got your line of credit growing, I was going to say going and growing, and especially the benefit if you need to take it, well outweighs the fees that are associated with it. So that's it. Again, my name is Jason. I hope you learned something from this. Obviously, if you want to investigate if a reverse mortgage line of credit is right for you, if you can qualify, and if you can qualify, how it can look for you, because again, everybody's different. Everybody has different needs, and a lot of times you might need a line of credit to pay off a small mortgage, or a lump sum to pay off a small mortgage and some credit cards, then monthly income just to set it straight, and then the rest in a line of credit, or maybe just a lump sum in the line of credit, or maybe just the entire line of credit. Everybody is unique. So hopefully that makes sense. So if you do want to learn about how it works specifically for you, feel free to give me a shout. My phone number is 888-309-9705. Again, 888-309-9705. My email is jason@keyhomelending.com. All this stuff's going to be below, by the way. And if you just want to set up an appointment, or if you want to just look and see what other, kind of how other seniors feel about reverse mortgages and kind of how our process went when we worked together, then go ahead to Reverse Quotes, www.reversequotes.com. All right, we're 16 minutes in. I am closing up the marker. That's it. Hopefully you enjoyed it, and I look forward to speaking with you soon. Take care of yourself.